I need you to stop what you're doing. Put down the coffee, close the other tabs, and look at the screen. Look at the price ticker on your phone. What does it say? It likely says something around $71. Ladies and gentlemen, Asian guy here, known as John AGI from Currency Archive. If you're looking at the COMEX spot price or the London Fix or any of the major Western feeds, you are seeing a number that hovers right there in the low sevens. And if you are a technical analyst, you are probably drawing lines on a chart, looking at support levels, and telling yourself that the market is consolidating. You're telling yourself that silver is holding the line, but I'm here to tell you that the number on your screen is a lie. It is not just a little bit off. It is not just a lagging indicator. It is a hallucination. It is a ghost signal from a dead system that hasn't realized it has stopped beating yet. Because right now, as I speak to you on the other side of the world, in the physical streets of Tokyo, the reality is violently different. We are receiving confirmed, verified reports from our sources on the ground in Japan that retail silver bars, the actual physical metal you can hold in your hand, the metal that protects you from currency collapse, are changing hands for 20,000 yen. Let's do the currency conversion together. At the current exchange rate, that translates to roughly $130 per ounce. I want you to let that sink in. $130. Now look back at your screen. $71, that is a spread of $59. That is a premium of 83%. In the history of modern financial markets, we have never seen a divergence this extreme between the spot price, which is supposed to represent the global value of the commodity, and the street price, which represents what people are actually willing to pay for it. An 83% spread is not a market inefficiency. It is a market failure. It is the financial equivalent of a heart attack. When you see a spread of 2%, that is normal. That is the dealer's profit margin. When you see a spread of 5%, that is high demand. When you see a spread of 10%, that is a supply squeeze. But when you see a spread of 80%, that is a complete systemic fracture. It means the mechanism that connects the paper market to the physical market has snapped. The cable has been cut, the elevator is falling, and the floor is rushing up to meet us. Now, I know what the skeptics are going to say. I can hear the comments already. Asian guy, you are exaggerating. Japan has high taxes. Japan has a consumption tax. It costs money to fabricate the bars. It costs money to ship the metal. You can't compare a 1,000-ounce commercial bar in New York to a 1 O's coin in Tokyo. And to those people, I say you are missing the point entirely. Yes, there is friction. Yes, there is VAT. Yes, it costs money to mint a coin. But friction does not cost $59 an ounce. It does not cost $59 to stamp a piece of silver. It does not cost $59 to ship a piece of silver across the Pacific Ocean. Even if you add up every single tax, every single insurance fee, and every single minting cost, you might get to $10, maybe $15 if you were being generous. Where is the other $45 coming from? It is coming from panic. It is coming from scarcity. It is coming from the fact that the Japanese yen is imploding. And the Japanese people, who are historically some of the biggest savers in the world, are rushing for the exits. They are dumping their currency and moving into hard assets at any price. They do not care that the COMEX says $71. They know that if they try to buy at $71, there is no metal available. The spot price is the price of a contract that settles in cash. The street price is the price of survival. And right now, the price of survival is $130. This divergence is the definitive proof that the arbitrage is dead. In a healthy market, the banks, the smart money act as the great equalizers. If silver is $71 in New York and $130 in Tokyo, a bank like JP Morgan or Goldman Sachs should be backing up the truck. They should be buying every single ounce of silver on the COMEX for $71. They should be draining the New York vaults dry. Then they should be chartering cargo planes, flying that metal to Tokyo, paying the taxes, paying the minting fees, and selling it for $130. Even with all the costs, they would make a risk-free profit of $30 or $40 an ounce on 1 million ounces. That is $30 million of free money. Banks do not leave $30 million on the table. They would kill for that kind of return. So why aren't they doing it? Why is the gap sitting there wide open day after day? Why isn't the arbitrage closing? Because they can't. The plumbing is clogged. The logistical chain that connects the 10 lb industrial bar in a New York vault to the retail market in Asia is broken. There isn't enough refining capacity to melt down the big bars and turn them into small bars fast enough to meet the demand. There aren't enough secure transport flights. And most importantly, the supply in New York is not as liquid as they pretend it is. If a bank tried to withdraw 10 million ounces from the COMEX today to ship to Japan, they would trigger a default. The exchange would stop them. They would force them to settle in cash. So the arbitrage trade is impossible. The banks are trapped in the paper world, and the retail buyers are trapped in the physical world, and the bridge between them is burned down. This is what we call bifurcation. It is the splitting of the world into two distinct realities. In reality, the paper world, silver is cheap. It is abundant. You can trade it with a click of a mouse. The chart looks ugly. The technicals are bearish. The price is $71. In reality B, the physical world, silver is rare. It is disappearing. You have to wait 6 weeks for delivery. You have to pay massive premiums. The chart is a vertical line. The price is $130. You have to decide which reality you live in. If you are a paper trader, you live in reality A. You're looking at your account balance and wondering why you aren't rich yet. If you are a stacker, you live in reality B. You're holding an asset that is effectively trading at double the market rate in the real world. The history of financial collapses tells us one thing. Reality B always wins in the end. The paper market can suppress the price for a long time, but it cannot suppress the physical shortage forever. Eventually, the paper market runs out of metal to leverage, and the two prices snap back together, and they don't meet in the middle. The paper price always chases the physical price. New York will have to rise to meet Tokyo. Tokyo will not fall to meet New York. But we have to be careful with this narrative. It is very easy to look at this spread, this 80% anomaly, and scream the banks are dead. It is very easy to say, look, JP Morgan is short silver at $71, but the price is $130. They are insolvent. The collapse is happening tomorrow. I see the YouTube thumbnails. I see the Twitter threads. Bankrupt implosion 0. I am here to tell you that it is not that simple. Yes, the banks are hurting. Yes, they are bleeding. But if you think a bank with $1.5 trillion in Tier 1 capital is going to collapse because of a few billion dollars in silver losses, you are underestimating your enemy. You're underestimating the armor they wear. To understand how this squeeze actually plays out, to understand why it is going to be a slow grinding war rather than an overnight victory party, we have to look at the balance sheets of the giants. We have to look at the death myth. Because the banks are not dead, they are just wounded. And a wounded animal is the most dangerous thing in the forest. Let's look at the math of their survival. If you open the latest commitments of traders report from the CFTC, the report that tracks exactly who is holding what on the COMEX, you will see a number that looks at first glance like a death sentence. The commercials, which is the polite name for the bullion banks like JP Morgan, Citibank, and Bank of America, are currently holding a net short position of roughly 40,000 contracts. Now, let's do the multiplication. One contract is 5,000 ounces. 40,000 5,000 is 200 million ounces of silver. That is the size of the bet. They are betting that the price goes down, or at least stays stable on 200 million ounces of metal, and right now the price is not staying stable. It is ripping. If silver moves from $71 to $100, a move of roughly $30, you simply multiply that $30 loss by 200 million ounces. The result is $6 billion, $6 billion in mark-to-market losses. In the real world, if a hedge fund lost $6 billion overnight, they would be liquidated. Their furniture would be on the street. Their CEO would be in front of Congress. It is a catastrophic amount of money. And this is why the internet is on fire with rumors. This is why you see the tweets saying Bank of America is insolvent or JP Morgan is trapped, because the math says they are underwater. The math says that every time silver ticks up $1, they bleed another $200 million in cold, hard cash. But here is the uncomfortable truth that the Fed crowd doesn't want to hear. $6 billion is a rounding error for these people. You have to understand the scale of the monster we are fighting. We are not fighting a small family office. We are fighting the systemically important financial institutions. Let's look at their armor. Let's look at their Tier 1 capital. Tier 1 capital is the core measure of a bank's financial strength. It is their equity, their retained earnings, the cash they have sitting in the vault to absorb shocks. JP Morgan alone has a Tier 1 capital buffer of roughly $300 billion. The total assets of the Big Four U.S. banks exceed $10 trillion. So compare the numbers. On one side of the scale, you have a $6 billion loss in silver. On the other side, you have a $300 billion safety net. The silver loss represents maybe 2% of their safety buffer. Does it hurt? Yes. Does it ruin their quarterly earnings report? Absolutely. The shareholders will be furious. The bonuses will be cut. The traders will be fired. But does it bankrupt the institution? Does it force them to close their doors and hand the keys to the apes? No. It is like you getting a flat tire on your car. Is it annoying? Yes. Does it cost money to fix? Yes. Does it mean you have to abandon the car on the side of the road and walk home forever? No. You have a spare tire. You have insurance. You have a credit card. The bullion banks have the ultimate credit card. It is called the Federal Reserve. And there is another layer to this survival story that nobody talks about. It is the hedge. We look at the COMEX short position and assume it is a naked short, meaning they sold silver they don't have just to gamble. But banks are not gamblers. They are bookies. And bookies always balance their books. While they are short 200 million ounces on the COMEX, the visible market, they are likely long hundreds of millions of ounces in the OTC market, the over-the-counter market that is invisible to the public. Think about how a bank operates. A silver miner in Mexico digs up metal. They want to lock in a price to pay their workers. So they call JP Morgan and say, I will sell you 10 million ounces of silver at $70. JP Morgan says, deal. Now JP Morgan is long 10 million ounces of physical silver or a forward contract for it. But JP Morgan doesn't want to bet on the price. They just want the fee. So what do? They go to the COMEX and short 10 million ounces. Now they are neutral. If the price goes up, they lose money on the COMEX short, but they make money on the miner's contract. The two cancel each other out. The 40,000 contract short position you see on the CFTC report might largely be a hedge against real physical metal they have contracted from miners. So when the price rips to $100, they lose $6 billion on the COMEX, but the value of their miner contracts gains $6 billion. Net loss zero or close to zero. Now, I'm not saying they are perfectly hedged. They play games. They take risks. They definitely have some naked exposure. There is likely a speculative portion of that short position that is bleeding profusely. Maybe they are unhedged on 50 million ounces. That is a $1.5 billion hit. That stings. That is painful. That is why we see the liquidity injections. That is why we see the stress in the repo market. They need cash to meet the margin calls on the short side while they wait for the long side to pay out. It is a liquidity crisis, not a solvency crisis. There is a massive difference. A liquidity crisis means you are rich, but you don't have cash in your wallet right now. A solvency crisis means you are broke. The banks are facing a liquidity squeeze. They need cash now to feed the COMEX beast, but they are not broke. This distinction is critical for your strategy. If you believe the banks are going to go bankrupt tomorrow, you might make reckless bets. You might buy call options that expire next week, thinking this is it, the collapse. And then the banks will just deploy their capital, meet the margin call, survive the day, and use their algorithms to crush the price back down to $70 for a few days to shake you out. They have the staying power to fight a war of attrition. They can absorb the pain longer than you can stay solvent if you are using leverage. This is a painful deleveraging. That is the correct term. They are unwinding their bad bets. They're eating the losses. They are stepping back from the market. Why do you think the price went from $20 to $71 in the first place? Because the banks are stopping the suppression. They are realizing that it is too expensive to fight the trend. When silver was $20, they could smash it easily. At $71, with a shortage looming, smashing the price costs them billions in collateral. So they are retreating. They are letting the price rise, but they are doing it in a controlled, managed way. They are managing the retreat. They are not dying. They are repositioning. And let's not forget the final safety net, the rules. If things really get out of hand, if silver goes to $200 overnight and the $6 billion loss becomes a $60 billion loss, do you think the exchange will just let the banks fail? Do you think the government will let the financial system collapse over a shiny metal? No. They will change the rules. We have seen it before. In 1980, when the Hunt brothers cornered the silver market, the exchange changed the rules to liquidation only. You could sell, but you couldn't buy. They broke the Hunt brothers to save the banks. In 2022, when the nickel market exploded on the LME, they simply canceled the trades. They rewound the clock. They said those trades never happened. If silver goes vertical to a point where it threatens the solvency of JP Morgan, the COMEX will declare force majeure. They will halt trading. They will force a cash settlement at a fixed price. They will say, okay, the price is $75, everyone settle here. Market closed. This is why I tell you, do not play their game. If you hold a paper contract betting on a collapse, they can change the rules of the contract. If you hold physical metal, they cannot change the laws of physics. They cannot cancel the bar in your safe. But as long as you're playing in their casino, the COMEX, the house always wins, or at least the house never dies. So, erase the bankrupt narrative from your mind. It is a fantasy. The banks will survive. They will limp away with a bloody nose and a smaller bonus pool, but they will survive. However, their survival mechanism, their retreat, is exactly what clears the path for silver to rise. They are no longer the wall blocking the price. They are becoming the speed bump. They are stepping aside because the cost of manipulation has exceeded the benefit of manipulation. And why has the cost gone up? Why is it suddenly so dangerous for them to short the market? Because of the physical variable. Because of the one thing they cannot hedge, they cannot print, and they cannot regulate away. The supply shock. The banks can play games with paper all day long, but they cannot play games when the physical metal stops arriving at the dock. And that is exactly what is happening today. The real threat to the suppression scheme isn't the bank's balance sheet. It is the China wall. Today, January 1st, the new laws in Beijing went into effect, and while we were busy looking at bank stocks and premium spreads, the Chinese government quietly closed the gate. This is the structural break that changes the equation for the next 10 years. Let's look at the pivot. Let's look at the red dragon. This brings us to the pivot. The moment where the narrative shifts from financial engineering to geopolitical reality. We have spent the last few minutes analyzing the balance sheets of Western banks, debating whether their $6 billion loss is fatal or just painful. But while we were distracted by the paper fire in New York, the real arsonist was lighting a match in Beijing, because today is January 1st, 2026. Look at the calendar. It is not just the start of a new year. It is the start of a new era in resource nationalism. As of this morning, the new Chinese export regulations regarding strategic dual-use metals are officially active law. And with the stroke of a pen, the largest producer and consumer of refined silver in the world has effectively erected a wall around its borders. You have to understand what just happened. The media is calling it export licensing. They are using soft language. They're saying, oh, China isn't banning silver exports. They are just requiring a license to ensure quality control. Do not be naive. Licensing is bureaucratic code for soft ban. Under these new rules, which we have translated and analyzed, the only entities allowed to export silver out of China are the mega refiners, the massive state-owned enterprises that report directly to the central government. The hundreds of smaller private refineries, the scrap recyclers, the trading houses that used to flood the global market with excess silver, they are cut off. They cannot get a license. They are now forced to sell their metal domestically. And what about the mega refiners? Do you think they are going to export? Technically they can, but practically they won't. Why? Because their mandate has changed. For the last 20 years, their mandate was profit. Their job was to refine silver and sell it to whoever paid the most, whether that was Apple in California or a bullion dealer in London. Today, their mandate is strategic security. Their job is to ensure that the Chinese solar industry, the Chinese electric vehicle industry, and the Chinese military complex have first dibs on every single ounce of metal produced within the People's Republic. They will only export if there is a surplus. And here is the terrifying reality. There is no surplus. China is currently running a massive internal deficit in silver. They produce roughly 3,500 metric tons a year from their own mines, but their industrial machine, the beast that turns out 80% of the world's solar panels, consumes over 6,000 tons a year. Do the math. 3,500 minus 6,000. They are in a deficit of 2,500 tons. In the past, they filled this gap by importing ore, refining it, and sometimes exporting the finished bars to balance the trade flows. But now with the solar demand exploding, specifically the new TOPCon and HJT panels that use 50 to 80% more silver per watt, their internal hunger is insatiable. They need every ounce they mine, and they need every ounce they can import. Exporting silver right now from Beijing's perspective is an act of treason. It is selling the fuel of the future to the enemy. So, the wall is real. It is not a physical wall of concrete. It is a regulatory wall of no Western buyers. Bullion banks like JP Morgan, tech giants like Tesla, who used to rely on a steady stream of Chinese silver to balance the global market, are waking up today to a dial tone. They are calling their suppliers in Shanghai and hearing, "Sorry, we can't get the license approved. Sorry, the Ministry of Commerce has flagged this shipment. Sorry, domestic demand has taken the entire lot." This creates a permanent structural deficit for the West. You have to realize how fragile the Western silver market actually is. The United States does not mine enough silver to meet its own demand. Neither does Europe. We are deficit regions. We rely on imports from Mexico, Peru, and China to keep the lights on. If you take China out of the equation, if you remove one of the three legs of the stool falls over. It means the West has to fight over the remaining supply from Mexico and Peru. It means the premiums in the West have to rise permanently to attract metal. This isn't a temporary squeeze that lasts for a week. This is a rewiring of the global flow of metal. For decades, silver flowed from east to west. Starting today, the river stops. In fact, the river might reverse. We might see China starting to bid aggressively from Mexican silver, competing directly with U.S. buyers. And this is where the industrial panic moves from a slow burn to a wildfire. We talked about Samsung and Tesla in the previous updates, but think about the second-tier companies. Think about the medical device manufacturers, the 5G infrastructure builders, the aerospace defense contractors. They don't have the political connections of a Tesla. They don't have the balance sheet of an Apple. They relied on the open spot market. They relied on being able to click a button and buy silver at the London fixed price plus 10. That world died today. Now they are staring at a market where the spot price is $71, but the China price is $110 and the Japan price is $130. They are seeing the global inventory getting sucked into the Asian black hole. This creates a psychological shift called inventory hoarding. In supply chain theory, when a critical component becomes scarce, companies stop ordering just in time and start ordering just in case. They overorder. If they need 10,000 ounces for February, they order 20,000 just to be safe. Because having too much silver is a small cost, storage fees. Having no silver is a fatal cost. Factory shutdown. This behavior amplifies the shortage. It creates a self-fulfilling prophecy. As soon as one company starts hoarding, everyone else must hoard, or they will be left with nothing. We are seeing the early signs of this right now. The phantom demand is rising. Orders are being placed not for consumption, but for safety. And this phantom demand is hitting a market that has just lost its biggest supplier. This is the real trigger for the squeeze. The banks can manipulate the paper price on the COMEX because it is a closed loop of digital contracts. But they cannot manipulate the fact that a factory in Ohio needs physical silver to make a cruise missile guidance system, and that silver is currently sitting in a vault in Shanghai that just locked its doors. The bank cannot print a bar of silver, and the bank cannot force China to export. For the first time in history, the Western financial elites are powerless against the physical reality. They can print dollars to bail out the shorts, but those dollars are useless if there is nothing to buy. What good is $1 billion if the seller says not for sale? This leads to a bifurcation of the industrial base. Companies with factories inside China, like Tesla's Shanghai Gigafactory, are safe. They can access the Chinese metal. They can pay the local price and keep running. Companies with factories in the US or Europe are in the kill zone. They are cut off from the Chinese supply. They are forced to source from the shrinking Western pool. This will drive the premiums in the West to match the premiums in the East. It has to. If silver is $130 in Japan, why would a miner in Mexico sell to a US refiner for $71? They won't. They will put it on a ship to Tokyo. Money goes where it is treated best. Commodities go where they are paid the most. Unless the COMEX price rises to match the Asian price, the COMEX will be drained of every single ounce. The miners will bypass New York. The refiners will bypass London. They will sell directly to the desperate buyers in the East. And this brings us back to the banks. Remember in part 2, we said they are not dead because they have Tier 1 capital. That is true. They have money. But money cannot solve a logistical blockade. JP Morgan can write a check for $5 billion to cover their short position. But if their client stands for delivery, if the client says, "I want the metal, not the cash," JP Morgan is in trouble because JP Morgan cannot get a license to export silver from China either. The armor of capital protects them from insolvency, but it does not protect them from delivery default. It does not protect them from the embarrassment of telling a client, "We don't have it." And that is the weak point. That is the thermal exhaust port on the Death Star, the inventory. The banks can handle a price squeeze. They can't handle an inventory squeeze. If the COMEX vaults run dry, if the registered category hits zero, the game stops. The illusion of infinite liquidity breaks, and thanks to the China wall, the replenishment rate for those vaults just dropped to zero. No new metal is coming from the East to save them. They are on their own. They are fighting a war with the ammo they have left in the bunker, and the supply lines have been cut. So, how much ammo do they actually have left? How close are we to that zero moment? We hear numbers thrown around, 100 million ounces, 50 million ounces. But we need to look at the real number, the number that is available for immediate delivery, the registered category. Because when you peel back the layers of the COMEX report, you realize that most of the silver in those vaults doesn't belong to the banks. It belongs to investors who aren't selling. The amount of liquid silver available to stop this panic is terrifyingly small. It is not an ocean. It is a puddle, and the sun is beating down. Let's look at the thin ice. Let's look at the specific inventory data that proves the COMEX is running on fumes. Because when you see how little is actually left, you will understand why the premiums are 80%. You will understand why the market is terrified. Let's open the vault. And when we finally pry open the heavy steel doors of the COMEX depositories in New York, what we find inside is not a fortress of infinite wealth. It is not a mountain of silver bars stacking to the ceiling, ready to flood the market and crush the speculators. What we find is a hollow echo. We find a crime scene where the evidence has been systematically removed bar by bar, truckload by truckload, until only the dust remains. We need to talk about the number 38 million. According to the latest daily warehouse stock report, which was released quietly while the media was focused on the New Year celebrations, the total amount of registered silver in the COMEX system has fallen to 38,200,000 ounces. Now, to the average person, 38 million ounces sounds like a lot. It sounds like a dragon's hoard, but you have to look at this number through the lens of the global market. The world consumes roughly 1,100,000,000 ounces of silver every single year. That averages out to about 3 million ounces of consumption every single day. So do the math. 38 million ounces divided by 3 million ounces per day. 12 days. That is it. The global benchmark for the price of silver, the exchange that supposedly sets the value for the entire planet, is sitting on less than 2 weeks of global supply. If the mine stopped producing tomorrow, or if the transport ship stopped sailing, the COMEX would be bone dry in 12 days. This is not a buffer. This is not a reserve. This is thin ice, and the ice is cracking under the weight of the demand we just discussed. But the situation is actually much worse than that headline number suggests, because the banks play a shell game with the inventory data to make it look healthier than it is. They will point to the total inventory, which is usually around 270 million ounces. They say, look, there is plenty of silver. Panic is unnecessary. But they are lying to you by omission, because inside that total number, there are 2 categories: eligible and registered. Registered is the metal that is actually available for delivery. It has a warrant attached to it. It is ready to be sold to fulfill a contract. That is the 38 million ounces. Eligible is the rest. It is roughly 230 million ounces. But eligible simply means the metal meets the purity standards and is sitting in the vault. It does not mean it is for sale. That metal belongs to private investors. It belongs to family offices. It belongs to people like you and me who simply pay the vault a fee to store it there. The banks cannot touch it. They cannot deliver it to cover their shorts unless the owner decides to sell. And ask yourself, if you own silver in a COMEX vault and you see the price in Japan is $130, but the bank wants to pay you $71, are you going to sell? No. You're going to hold due, or you're going to withdraw it. So the eligible pile is effectively frozen. It is dead weight. The only liquidity in the system is that tiny shrinking pile of 38 million ounces in the registered category. This is where the economic law of gravity takes over. We call it Gresham's Law. You may have learned it in EAN 101. Bad money drives out good, but in the context of the silver market, it means fake paper prices drive out real physical metal, or when a commodity is priced artificially low, when it is subsidized by paper manipulation, the market will drain the physical supply until there's nothing left. Think about it. The COMEX is essentially a store that is selling silver for $71. The rest of the world, Japan, China, the UAE, values that same silver at $100 or more. What happens when a store sells iPhones for $500 when they are worth $1,000 everywhere else? You get a run on the store. Smart money, arbitreurs, industrial buyers, sovereign wealth funds will stand for delivery on the COMEX, not because they want to crash the system, but because it is the cheapest place on earth to buy metal. They are looting the vault legally. They are using the bank's own suppression scheme to strip mine the exchange of its assets. This is why the inventory is plummeting. It is not an accident. It is the direct mathematical consequence of the price suppression. The banks are victims of their own success. They suppressed the price so effectively that they made silver the most undervalued asset on the planet. And now, the world is backing up the truck to take it away from them. Every time they smash the price down to $71 to save their short positions, they inadvertently ring the dinner bell for the physical buyers, and they are shouting flash sale at a discount, and the buyers are responding. Withdrawals are accelerating. We are seeing loadout notices, requests to physically remove metal from the vault system, hitting levels we haven't seen since the silver squeeze of 2021. But this time, the inventory is starting from a much lower base. And here is the terrifying part for the shorts. The refill mechanism is broken. In the past, when registered stocks got this low down to 30 million ounces, the price would rise a little, and metal would flow in from London or China to replenish the stock. The eligible holders would be tempted to sell. The miners would ship extra bars. But today, we just established in Part 3 that China is closed. No metal is coming from the East. And the eligible holders, They're looking at the inflation data. They're looking at the war drums. They're looking at the premiums. They're not selling at $71. They're waiting for triple digits. So the refill isn't happening. The drain is one way. It is a bathtub with the drain open and the faucet turned off. It is a mathematical certainty that the water level will hit zero. So what happens when it hits zero? What happens when a register drops from 38 million to 10 million and then to zero? Does the world end? Does the COMEX explode? No. The system protects itself. This is where the paper game reveals its final trick. The exchange will likely declare that they are suspending physical delivery. They will cite logistical bottlenecks or market irregularities. They will invoke the force majeure clause in the contract, and they will say to the people waiting for their metal, "We are very sorry. We cannot give you the silver bars, but good news, we will give you the cash equivalent." They will settle the contract at $71. They will force you to take the paper currency that you are trying to escape. This is the moment of default. It won't be called a default on CNN. They will call it a settlement procedure. But to anyone who knows what money is, it is a default. If you bought a car and the dealership took your money and then said, "Sorry, no car, here's your money back," you would be furious, but at least you have your money. But in the silver market, getting your money back is a disaster, because while you are holding your $71 of cash settlement, the real price of silver in the physical market, the price you have to pay to actually get metal, will be gapping to $150. You will be priced out forever. You will be left holding a bag of depreciating fiat currency while the asset class leaves the solar system. This is why the inventory data matters so much. 38 million ounces is the countdown clock. Every million ounces that leaves brings us one day closer to that cash settlement moment. And the smart money knows this. That is why the drain is accelerating. It is a game of musical chairs. There are thousands of paper contracts, but only 38 million ounces of metal. When the music stops, and the music is stopping right now, only the people sitting on the physical bars will win. Everyone else gets a check that can't buy anything. And do not underestimate the speed at which this can unravel. In a panic, inventory doesn't drain linearly. It drains exponentially. The moment the headline hits, COMEX registered, silver falls below 20 million. The psychological dam will break. Hedge funds that usually trade paper will say, "Get me the metal out now." Industrial users will say, "Secure the inventory regardless of cost." We could see that remaining 38 million ounces vanish in a single week. We saw it happen with nickel. We saw it happen with palladium. When the bottom falls out, it falls out all at once. So we have a banking system that is bleeding liquidity, but armored with capital. We have a Chinese supply shock that has cut off the flow of new metal. And we have a COMEX vault that is running on fumes, sitting on less than 2 weeks of supply. This is the perfect storm for a structural repricing. But it is not going to be a straight lineup. The banks are not going to roll over and die. They're going to fight. They're going to use every weapon in their arsenal to make the path to $100 as painful, as volatile, and as confusing as possible. They are going to try to shake you out before the payoff. How will they do it? What is the roadmap for 2026?